Onto your markets now. Asian markets traded mixed today, with trade tariff concerns continuing to overshadow activity. Market players are keeping a close eye on the impacts of the higher global aluminium and steel tariffs imposed by the US, which took effect last Wednesday. Mainland China and Hong Kong traded in the red, this as China's latest consumer inflation print dropped below zero for the first time in 13 months, with CPI declining by 0.7% in February. Serious concerns remain about China's economy being deflationary. The Nikkei share average rose by 0.4%. The Hang Seng index closed down 1.85%, while the Shanghai Composite Index declined by 0.2%. Over in the United States, equities all ended Friday's session in positive territory following a volatile week as market players digested the implications of trade wars between the United States and its major trading partners. Meanwhile, Fed Chair Jerome Powell signaled that the central bank would be in no hurry to cut interest rates further. The Dow Jones Industrial Average rose by 0.52%. The S&P 500 gained 0.55%, while the Nasdaq Composite Index closed up 0.7%. In terms of our local indicators here at home, we see that the all-share index is trading in negative territory. It's down 0.7%. On the currency front, we see that the rand is trading at 18.30 against the US dollar, 19.88 vis-a-vis the euro, and 23.63 against the British pound. In terms of commodities, we see that gold is trading at $2,904 an ounce, platinum at $970 an ounce, while Brent crude oil is trading at $70.53 a barrel. Well, let's unpack the markets further with Victor Siani. He is a portfolio manager at Benguela Global Fund Managers. Thank you so much for joining us, Victor. So right now we see that a lot's been going on in the United States. Last Friday saw the release of the US payroll numbers. There remain concerns about the trade tariffs that have taken effect. And on top of that, President Trump hasn't ruled out the possibility that the US economy could be going into a recession. Your thoughts?
Yes, thank you for having me, firstly. We are in a very volatile state of the market at the moment. One indicator that we keep our eyes on is the volatility index, also known as the VIX for short. And that indicator typically, over the long term, since its introduction in the 1990s, its median level was about 17 points. Right now, we're sitting in the region of about 25, 26 points. Now, the VIX only spends its time at a level above 25% of the time. So we in a very rare period where that VIX has spiked. So a lot of market participants are nervous. We had the payroll numbers coming in last Friday below expectations, and that's an indicator that the U.S. economy may be softening. The government sector in the month of February also lost 10,000 jobs, but you'll recall that that's before Elon Musk's drastic cuts to employment in the U.S. Government sector. So we'll see more job declines come through in the month of March. And as far as tariffs are concerned, tariffs would be negative for the U.S. economy. It's likely to raise prices as importers of goods pass on those costs to consumers. And that could lead to a knock to consumer confidence as well as business confidence as costs increase, thereby leading to lower investment. And so we could see a slowing U.S. economy and perhaps even a recession.
Yeah.
The U.S.
Thank you very much for that very clear explanation. So I mentioned concerns around the Chinese economy going into deflation territory. Just explain why it's problematic for an economy to go through this. And given its relative importance to the South African economy, what are the possible implications?
Yes, we saw a deflation wreak havoc on the Japanese economy from the period of the 1990s through to the 2010s. And that leads to a number of things. First, consumers delay their spending. Businesses also delay their spending, and therefore that leads to less consumption, lower demand, and a decrease, therefore, in economic activity. Also, it increases the real level of debt, because as incomes decrease, people are less able to pay down their debts. We know that China still has a bit of a debt problem in their property market. So that debt not being able to pay down leads to a bit of stagnation in that market. And so overall, it leads to lower economic growth. And that'll be negative for South Africa because South Africa does depend on China for about 12% of its total exports of iron ore, manganese, platinum group metals for vehicles, and so on. And that could lead to lower exports from South Africa and have a negative impact on South Africa's GDP growth.
So this week is Budget 2.0. What are your expectations, especially as the 2 percentage point increase in VAT appears to be off the table, even though there's talk that there may be a 1 percentage point increase, but we just don't know?
Yes, definitely. My expectation, there'll definitely be a compromise. If a VAT increase is passed at all, it'll be lower than the 2%. But this will force government to think of other much harder ways to improve the fiscal debt situation, such as cutting expenditure, perhaps in certain unpopular areas, perhaps such as social grants, forcing the government to perhaps raise revenue from other sources, such as privatizing some state-owned assets. Transnet could be one of them in order to improve the logistics situation in South Africa. And then finally, prompting the government to introduce more broader economic reforms in order to stimulate economic growth and thereby, in the long run, generate more tax revenue to avoid things like VAT increases, which is an easier path to paying down fiscal debt.
Yeah. One last one. A company came out today, a JSE-listed consumer-facing AVI released their half-year results, reporting revenue up 1.1% in the 6 months to December 2024 and profit up by 8.9%. Just give us your take on their results and how you think they're doing vis-a-vis the consumer.
Yes, AVI, in my view, has one of the very best management teams in this country. Management always finds a way to eke out good profit growth, above inflation profit growth, even in difficult circumstances that they experienced during this year. Almost across all of their divisions, their volumes were lower as consumers continue to be under strain. They were fortunate that they were able to pass through some price increases, especially in their coffee brands, coffee, tea, and creamer. There were some major price increases, which helped them increase their margins. There were some difficulties, especially in their biscuits business. We saw that choice assorted biscuits, which are very popular in South Africa during Christmas season. In fact, the volumes in that category decreased, as well as in Snackworks, despite them introducing more affordable pack sizes, such as a new cheese curls format. But management overall has done well to control costs, and that has led to a 9% growth in profit, despite only 1% increase in revenue, and very good cash generation. So I expect this disciplined execution by management to continue.
Excellent. Victor, thank you so much for speaking to us. That was Victor Siani. He's a portfolio manager at Benguela Global Fund Managers.